Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going through Twitter. Do it again. Almost coming up as a daily thing. We'll see what people are talking about. We're going to go over commodities, financial related topics, wealth building topics that I'll cover, and I'll interject my financial opinions across the board. And again, we'll go straight into it. If you want to follow me, it's at finding_finance, or you can join the finding-value.com. Um, We still have a discount going on. You can use the word discount in the coupon code, give yourself a little bit of a discount. So coming up here, it says, it's all about deferred gratification. When you look at the mistakes you make in life, private or professional, it's almost always because you reached for some short-term fix or some short-term high, and that's the overwhelming habit of people in the stock market. So they're trying to get rich quick. It's the deferred gratification, the patience that gets you where you want to go. Here it says no one's paying attention. So updated money velocity report will be at the end of the month, but current rate of year over year increase is the highest since the data has been recorded for the velocity of M2 money stock. My theories around this is that money hasn't really changed. The velocity of money through the system hasn't changed from money exchanging hands, perhaps, but money coming out of assets that were located in other portions. So if you maintain the numerator of money moving through the system, if that's constant, but money that's not moving in the system that is in financial assets, and those financial asset money is coming out of the system, your velocity would kick up just like we're seeing. So the velocity could remain the same, but QT could be taking money out of financial assets, which is impacting the velocity of money. As you can see, we saw a large decline in velocity of money when that money printing occurred in 2020. And that, I think, is some of that unwinding. So I don't think the money in the system that's circulating is being impacted all that much. It's money that went into financial assets, which is coming out of financial assets. It says you raised rates, no one is selling. Who wants to sell their house they got at a 3% interest rate to buy an inflated new one at 7%? It is creating a housing scarcity for now. This is Williams, a bit of surprise to see resilience of the housing market. I don't know if that is necessarily 100% the case. I mean, I'm sure there's a lot of people that are like that. But uh, just because interest rates are high and people are not moving in the system doesn't mean that you're creating more housing stock, if that makes sense. If there's a scarcity in housing stock, just because people are not selling doesn't mean that there isn't scarcity. So what this person is saying is they're saying it is creating a housing scarcity for now, but it's not, because the person who's selling a house more than likely will need to buy another one. So the reason she's putting here is not increasing the housing stock. I think what she is saying is actually a false statement. A true statement would be that people who are living at home don't want to buy homes because interest rates and the affordability are too high. It's not because someone who's already in an existing home and has a 3% rate doesn't want to move into another house and reset that, because you're not adding to the housing stock. You still need a house in order to sell the house. So it's a wash. You're just basically cutting out the real estate agents at that point. They're not making money from transactions or turnover. I don't think it actually increases or decreases housing scarcity. I think it has an absolute zero impact. If anything, it is helping. Actually, I'm going to change my mind. I think high rates are actually increasing the housing stock because it's going to defer away from investors and people buying second homes. If we had really low rates, if it was 2.75 or 2.5% rates, or if we had 0% rates, if someone said, you know what, I'm going to give you a 0% rate, I would buy another house and have another house myself. So I would say that higher rates for people like me and probably people like my brother and maybe even my parents, it's deferring second house purchases from us. It is creating more housing stock, and the scarcity is actually, it's not creating scarcity. So I think this person's actually wrong. If you gave me 0% rates, I would buy another house. It says you'll be praying for these rates when they hit 10% later this year. We did break out to the upside for the 10-year, 30-year yields. Right now, it says the average 30-year fixed rate mortgage is up to 7.08%. So yeah, they're creeping on up, and it looks to me like interest rates could continue higher when looking at the 10-year yield and charts. This is from K Kim. He says if this is true, the S&P 500 is going to 400. 400. Last time SPX was at 400 was December of 1991, and what he's taking is legendary investor Jeremy Grantham says the stock market has a 70% chance of crashing, and it could be an epic burst like the 1929 crash. I don't think that's going to be the case. I think legendary Jeremy Grantham probably doesn't understand where that crash came from. In the 1920s, the mid 1920s, there was a large deleveraging event in the housing market. We had a very large real estate bubble, much like the mid 2000s. They gave out just complete garbage loans in the 1920s. We're talking anybody who had a pulse got a loan. And there was rampant speculation in the real estate market in the mid 1920s. All of that collapsed. And when it collapses, the house prices collapse, people go underwater, and there was a lot of bad loans. Those bad loans is the destruction of credit, which caused a banking crisis. That is what caused the the or I should say, the housing market caused the stock market in the 1920s to absolutely collapse. It brought everything down, just like 2008, the great financial crisis, just like uh, early 1980s, and that was the best time to buy stocks, which was the early 80s. In that crisis, the housing market kind of pulled on back. We had a crisis there. We overbuilt in the early 1980s, and it brought everything down. And that was the best time to buy stocks, was in the early 1980s when stocks were cheap. We were in a recovery phase. We had a declining interest rate environment for 40 years. That was the time to load up on stocks as much as you possibly could. And again, I think we're in the same situation as the early 1980s, but in commodities today. It's the same exact setup, but reversed. I think we are at a very low interest rate environment. Interest rates are going to continue to go higher. We are going to get a pullback in stocks at some point, and I think we are massively undersupplied for the next decade in commodities at the same time that we're in the thick of credit expansion in loans for the millennials. I'm not saying that millennials can afford housing at this price and at these interest rates. At least it's not going to be easy for them, but we are in the thick of that demographic. Here it is. Some of these oil companies looks fiery. This is a CPG, Crescent Point Energy. This is an inverted head and shoulders that has broken the neckline and is consolidating right above it. Much like the way that it fell, you can see on the left-hand side here that it consolidated for a good long time. That's where we're consolidating. It's much like a lot of these other ETFs that we look at, where they consolidated before the drop. I think we've got some massive moves to the upside that are possibly coming in oil, especially. The reason I say that is we just broke out in oil. So my take is that oil is going to go to levels that people are going to call me ridiculous if I were to say those levels. So I won't say them, but I think they're going to go much higher than where they are today. Here's lithium. Lithium is also creating that setup. We're about to break to the upside here. I think we've already broken, depending on how you draw the charts. If you use the closing prices of the candlesticks, it's already broken out. He's using the, we'll call it the, where it's traded throughout the day, not the closing candlesticks. But lithium does look very good to take off. Looks very good. Here's oil. It says oil is finally breaking out of its descending triangle. Completely agree there. There we are breaking out. Get ready for a move to the upside. The energy service companies are also another area that I would be heavily looking at right now. I have my favorite picks. There are some ridiculous setups out there right now. And again, if you want to know those setups, you can go to finding-value.com, use that discount coupon code, and hit up my uploaded midweek updates and the question and answer session videos. We've got one coming up this weekend as well, Sunday, 7 a.m. Sunday. I can't make the Saturday, but Sunday, 7 a.m. Mountain Standard Time. Go there and ask questions. There's some really good setups, and this is the time to get very interested in a lot of these setups. We we are seeing these breakouts like lithium, rare earth metals, oil is starting to break to the upside, and I'm also seeing positive moves in a lot of the companies. Some of the companies, exploration, production, are breaking to the upside of their patterns, much like Crescent Point, but even other ones that are a little bit more leveraged. And some energy service companies look absolutely excellent. We're talking multi baggers ahead of us. If for the patient investor, I'm not a short term market timer. I am a long term investor in value. And that's what I'm looking for. I'm looking for the breakout. I'm looking for the value. I'm looking for those alignments where I can make a lot of money. Coming on down, we've got CCO. So what is this? This is Camco, I think, divided by housing. So this is the interesting ratio. It's a uranium blue chip miner versus the median sales house price. And what we've got here is an inverted head and shoulders that broke out last bull market in the mid 2000s. We've got the same setup. It's an inverted head and shoulders, basically ready to break to the upside potentially. So that is a very interesting. And you know what? Uranium and a lot of these, we'll call it commodity companies, they outperform when the housing market goes up. That's where the inflation is coming from. That is the real estate cycle. That's a cycle that we look for. We've got oil here. So that's a 4.4 million drop after a 1.4 million SPR release. It equals 5.8 million barrels per day short on production. 830,000 barrels per day Permian peak on hand. I don't know if the Permian's peaking. A lot of people are speculating on that. I don't know if it's peaking because the prices are too low. I don't know if it's peaking because we actually have geological constraints that we can't flow the oil fast enough. We won't know until prices go up. So I'm going to be reserved and say we don't know if this is peaking yet. We need to see 100, 120, $140 oil to see if we can get more out of the shale. Then we can say it's peaking if they can't produce more. It says when you think it can't go any tighter, this is uranium miners, guys. Uranium miners look really good. We are consolidating. And you can see a downtrend line. It looks like we're basically ready to break out. We've got increasing volume, the decreasing volume on the pullback. That's exactly what you want to see on a pullback. And then we should see, hopefully, an increase in volume coming up. We've got lots of support right underneath us. It's actually not a bad spot to be looking if you guys are interested in uranium miners. Here's another one. This is an energy fuels. He says, I like everything about this chart. This is a big wedge breakout. Big bottom head and shoulders formation and a measured move to the Fukushima highs of 2011. Great alignment here. So it's coming on down. We've got a falling wedge. We've broken the falling wedge here in 2020, late 2020, and then we've consolidated and we're ready to break to the upside, hopefully. with very large price targets to the upside for energy fuels. We have a problem. United Kingdom 10-year bond yield just keeps going higher and higher. We can see those yields creeping higher in America as well. Tavi says the recent divergence between the Nasdaq and Treasuries appear to be completely unsustainable. Ultimately, the present value of long duration businesses must reflect the ongoing rise in discount rates. I agree with this, guys. This is important. Equity markets, particularly mega cap tech companies, have completely ignored the rising duration risk this year. Although some investors have attributed the increase in long term interest rates to a perceived improvement in the economy, the macro data certainly does not support this narrative. The decline in treasuries has been mostly caused by the massive increase in the supply of these instruments. Last month alone, we saw 850 billion of treasury issuances, the second largest monthly figure in history. This supply pressure is unlikely to stop with a fiscal deficit that remains nearing 8% of GDP, causing the debt problem to compound at an alarming pace. So, what he's noticing is that the treasury market, generally, when it goes up, so this is the US Treasury 10-year treasuries, is when they go down, we've seen the NASDAQ diverge from that. They generally move in lockstep together. This here is an anomaly. I think that this gap's going to close where the Nasdaq falls quite dramatically. That's my take on it. Uh, as long as interest rates continue higher, there's a disconnect here, and that disconnect I don't think will remain forever. I think the Nasdaq will go down, but some people maybe they think interest rates will move lower. Even if interest rates move lower in a very fast fashion, that means that you probably have a crash on your hands. So either way, it's not a very good thing for the Nasdaq. Supply crunch to hit the oil markets, public. I already talked about that. Japan's gas inventories fall to the lowest level in a year. Bloomberg. We've got the most common cause of low prices is pessimism, sometimes pervasive, sometimes specific to a company or industry. We want to do business in such an environment, not because we like pessimism, but because we like the prices it produces. It's optimism that is the enemy of the rational buyer. And someone says under here, sounds like the current environment for gold and silver mining stocks. It really is. They're so pessimistic over there. That is when you want to go fishing. Fishing for companies, fishing for stuff that could potentially work out in your favor. Now, here's the Fed funds curve has inverted for the first time since the 1980s. Each inversion preceded a recession. Now, my question is, or my statement might be, how far down are we going to go? How inverted is this curve going to get? What if we get down to levels like in the 1980 where we go all the way down to -6? And what if it takes us a couple of years to get there? That's my take. It could potentially happen like that. Now, I'm not saying that's 100% an outcome. I'm just saying it's a possibility where the curve inverts a lot further than where we are today. So we might still have years ahead of us where the housing market needs to build all these homes over a few years, and that we could have the yield curve invert even further. It says housing in a world where everyone has 3% mortgages and can't afford to sell and buy something else at the current 7% rate. This is a total fiasco and not healthy. New construction should never be 1/3 of total inventory. The housing market is broken, is what this person's stating. And there we are moving on up. Very few existing homes for sale, and the new home supply as percent of total home supply is very high. I don't think the housing market is broken. What I think is happening is Powell knows that the inflation is going to come from the housing market. So what he has done is he has raised interest rates at a very fast pace to slow the market down. I think he's kind of screwed here. Because if you lower rates, this will come back down if rates do come back down, but your volume of home sales will increase and the inflation will come back. If he's trying to slow inflation, he must keep the interest rates at a very high level to slow the whole thing down. That is how he is controlling it. If he doesn't do it, you get the inflation. And he's worried that the inflation could be so dramatic and so intense that it will basically become out of control and could spiral out of control. So that's what he's doing. And this is just data supporting that viewpoint that I just told you. This data is saying, hey, look, he's slowing this thing way down. And we're seeing things distort to levels that we've never seen before. At this point of the cycle, we are right at the beginning of an expansionary phase of real estate. And we are at the one of the largest times where we've got the greatest imbalance of home buyers versus supply. And right now, what he's doing is he's yanking the affordability to a level that people can't afford, and he's slowing everything down. That's what he's doing. Now, I don't know what his second act of this move is. I don't know what he does next. Is he just going to leave it up there and bankrupt basically bankrupt the government because the deficit spending is so dramatic? Is he going to lower it to save them, but then have inflation from the housing market? I don't know what the second act of this play is. You raise rates to a level, and then it's like, what do we do from here? What's the next move? And he's going to have to hold rates at a very high level for a very long time if he wants to slow this thing way down, which is possible. And he knows, I think he knows exactly what he's doing. He knows that he has to do that, but I don't know what the government's going to do and how they're going to handle that aspect of it. Here's gold. It says trades within an 8-month broadening rising wedge formation. Technically, metal broke a 2-month resistance here, so it's starting to break to the upside according to him, and maybe we can get a big move in gold potentially. Here we go. It says getting rich, optimism, risk taking, swing for the fences. That's getting rich. Staying rich is a little pessimistic, skeptical, room for error. I try to play in the middle of these two. I want to stay rich and I want to get rich. And the way that you do that is you don't necessarily want to go full bore, swing for the fence with everything you got. What you want to do is you want to train and get in some of these companies that are just beasts, where they've got cash flows and they're completely mispriced, where you are basically skeptical, but you can swing for the fence at the same time. That is where the investor needs to, we'll say, overweight those companies. High probability, large mispricing, and very bad sentiment of that sector. And the combination of all those things is where you want to be. When the sentiment comes around and is a lot more optimistic, that is where you can get very big gains. And some of these companies, I think they can go 10, 14 times your original purchase price and still be skeptical, room for error. So it's a getting rich while staying rich opportunity. It's in the sweet spot. Good risk reward, good upside potential with good downside risk. So it says without passion, you don't have energy. Without energy, you have nothing. The earlier you find your passion, the better, because it won't seem like a chore to follow your dream, and you'll outwork everyone in the process. I would agree with that. We tend to prefer businesses that drowns in cash. Totally agree with this, guys. I call them cash cows, and that is where you want to be. You want to chase cash flows. And I've said this to the members a good while back. I think a lot of people actually changed their paradigm and how they invest based off of me talking about all that. I said, you know what, you can speculate, but these companies that just don't have any money, and they don't even you don't even see how they're going to make money 5, 10 years from now. I mean, you're really going out on the risk curve there. But what about you've got companies that have all the infrastructure in place? They've got everything in place to generate cash. They just need the price to go up a little bit. If that's the case, then you can see the path of how they can make all this money. And some of these companies, they're still drowning in cash. They've got incredibly low valuations. And if the market conditions change even more favorable for them, they're going to make even more cash. And then they're going to return that cash to you as a shareholder, either by buying back shares or paying it to you in dividends. So, yeah, I think that's pretty good. Logan's hitting on my boy Reventure Consulting. says, if I ever turn into a doom porn person, please, out of mercy, everyone block me. And this guy is literally, look at all this. It's all doom, 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 doom. He's getting a lot of views. I'll give him that. He probably makes a bunch of money off all those views, but yeah, I agree with him. And that's where I'm going to end it, guys. That's where I'm going to end it. So that's what I've got for today. If you guys enjoyed it, give me a thumb up. Subscribe to the channel. Definitely check out the website. Again, we've got a Sunday 7 a.m. Mountain Standard Time. That is different than normal. So make sure if you're going to attend that it is different. Sunday 7 a.m. Mountain Standard Time. I can't make it on Saturday. I've got a scheduling conflict. I'll just say that, which rarely comes up. All right, guys. That's what I've got for today. We'll catch you guys later. This is Finding Value.